We're in the worst recession since the Great Depression. But some people have been able to take advantage of the current situation and put themselves in the best financial position of their lives. If this recession hasn't been a big enough wake-up call for you to get your finances in order, I don't know what will. In this video, I'm going to go over the truth about how Australia's elite have really created their wealth in a much shorter amount of time than most. Now, full disclosure, I'm not a wealthy snob yet, but I'm getting there. I'm just an everyday Australian like you trying to figure out what the heck do I do during these crazy times to create wealth and provide a better future for me, my wife and my son. I've been studying the lives of Australia's super rich to figure out how they created their wealth and how you can too. Let's have a look. If you thought becoming a millionaire was impossible, here's a fun fact. There are actually 1,180,000 millionaires in Australia, and there are also over 50 million millionaires globally that have a net worth of $1 million or more. So if millions of people can do it, you can too. According to the Australian Business Review, the top 250 richest Australians have a net worth on average of 1.51 billion. That's right, on average 1.5 billion. And there is actually 117 billionaires in Australia, 29 of them are women, and the average age is 65. The richest man in Australia is Anthony Pratt and family, worth a staggering 16.95 billion. His role being executive chairman, advisory and owner of Pratt Industries, a manufacturing business, and he is also based where I'm from, Victoria. The second richest person in Australia is Gina Rinehart, worth a staggering $16.2 billion. Gina is a chairman at Hancock Prospecting, a mining company in Western Australia. And coming in at third, and once the richest man in Australia, is good old property developer Harry Triguboff, worth $15.5 billion, and he is a managing director at Meriton. The average wealth of the top 250 just keeps rising, where last year each person saw the average net worth increase by 240 million. That's right, 240 million per year. So what the heck are they doing, and what can we do to learn this? The question is, given markets are falling, can their wealth keep climbing, and can asset prices keep climbing to keep up this huge amount of wealth creation? The list is the biggest study of Australia's most wealthiest individuals, and their net worth is calculated at the end of February each year. And if you're wondering what sectors have created the most millionaires in Australia, those sectors are finance, property and mining. Did you know Australians used to have the highest average net worth in the world? In 2018, Australia's average net worth was 191,000 US, which fell to 181,000 in 2019, and so then were overtaken by Switzerland, which now has an average net worth per individual of 227,000 US. Those damn Swiss just beat us. But if you're wondering, hey, I don't know many people that have an average net worth of 181,000. Well, again, this is just a medium, and this includes people, that have billions, and it also includes people that have nothing. So this is just how they calculate the medium. Credit Suisse did a report, and the report reveals most of our wealth is tied up to housing and the property market. So when the property market has a downturn, this has a huge effect on consumer confidence and the wealth effect in Australia, and puts Australia at big risk by having most of its eggs in the property market. Non-financial assets, including property, accounted for 58% of Australia's household wealth, and that is compared to just 35% in the US, so this proves that most of our wealth is tied up in property. This is why the government and the Reserve Bank of Australia are so obsessed with property, and why they pump money into the property market, because it has a much bigger effect on the economy and consumer confidence than other industries. According to Forbes, most ultra-high net worth individuals have their portfolio structured something like this. The two largest holdings in property and equities, aka shares, followed by bonds, fixed income, and cash or other currencies. So what have I learned from studying the lives of Australia's super rich, and how did they do it? Well, it's quite simple, but quite hard to do in practice. It all boils down to three things: earning, saving and investing. But I'm going to dig a bit deeper into each three topics and figure out how we can use these tools to get ahead. Okay, earning. Now, earning more money is probably the hardest thing to do out of the three for most people, so let's smash this out first. So to earn more income, probably the easiest thing you can do straight away is do more overtime or get a side hustle in the gig economy like Uber, Lyft, or being a delivery food driver. Alternatively, you can get a higher paying job in the field that you're already in that pays more for experience. For example, if you're a factory worker and you're a pickpacker, and then there's a factory down the road that's looking for experienced pickpackers and they're willing to pay more, this is the quickest way to get a pay rise. You can also do things that will increase your value in the workforce, like getting a higher education or getting extra skills that are highly valued. Again, using a factory example, if you're just a pickpacker, but then go get your forklift license or high reach forklift license, you'll be paid more because there is less forklift drivers than pickpackers and there are less people that can do it. You are more skilled and the company will pay you more. Wage growth over the next 10 years is going to be terrible, so you need to take matters into your own hands and find ways to increase your income instead of relying on your boss to give you a 1, 2 or 3% pay rise every year. Once you have done this, the thing you need to do to take your income to the next level, and the thing that all wealthy people have done to create huge amounts of wealth in the shortest amount of time, is creating a disruptive business that disrupts an industry that you're passionate about, where it provides huge amounts of value to the community and solves problems for many people. I know it's easier said than done, but if you dedicate your life to this instead of dedicating your life to a job, and if you keep looking for problems and you do find a solution for many people, you'll be rewarded greatly. You could dedicate your life to your job, and if you're lucky, you may become a managing director earning 200 to 300k a year, or you could dedicate your life to following your passions and solve problems for many people, and you may even make billions. Another secret that I found from studying the lives of the super rich is they don't earn their income as an employee, they earn their income through businesses. That way they have much more tax deductions and they can spend first and then pay tax later instead of having to pay tax first and then spend. Some of them pay little to no tax at all because of the huge amounts of tax deductions. Just imagine being able to claim your house, your car, and everything you own on tax. You can't do this as an employee. And like I said before, if you're on that highest tax bracket as an employee, you're getting taxed 45% plus 2% Medicare levy. Now you may be wondering, so what are you doing, big hot shot? Now again, like I said, I'm just an everyday Australian trying to figure out what to do to get ahead. And what I've done and what I'm passionate about is YouTube. So I've created this YouTube channel where I'm trying to provide content that gives value to people's lives and that could help them with their personal finances. Rule number 2, they live below their means and save. It doesn't matter how much you make, even if you're making 200,000 to 300,000 per year, but you're spending every penny on luxury items and dropping $500 going out on the weekend with the boys. The boys! This is why some professional athletes that make millions end up going broke, because they don't know how to manage their money and they always live above their means no matter how much they make. So, how can we save money and greatly reduce our monthly expenses? You're not going to do it by saving $5 on coffee. You got to smash out the 3 biggest expenses. And the 3 biggest expenses in Australia is housing, transportation, and food. So let's have a look at housing first. Okay, let's get down to business. So housing for most people is the biggest monthly expense they will have. But there are actually some really creative and smart ways you can reduce this. Some people even bring it down to almost zero. You can do this by, if you're young, moving back in with mum or dad to help them out during these hard times by paying board. But if that's not an option, there are many other ways. If you're staying in a big house or expensive area, you can downsize or move to a cheaper area. Or alternatively, some people that have big houses that a lot of people like, they've found smart ways to greatly reduce their expenses for that big house. And they do this by something called house hacking, where say for example you have a 4-bedroom house and you've got 2 to 3 other spare bedrooms. What they do is they actually rent out those other 2 to 3 bedrooms per week to cover their monthly mortgage. And also some people do this to create passive income. And I think this trend is going to continue as people during these hard times look for more affordable housing. Now there are some other ways if you don't own a house to house hack. if you can get approval from the landlord, you can actually rent out the other 2 to 3 spare bedrooms, or you can house share with mates to greatly reduce your monthly expenses and split it 4 ways. That way your monthly rent bill or mortgage bill will be smashed. Okay, one of the other big expenses, transportation. Now, this is one we can actually reduce to 0 if you really want to increase your savings rate and if you really are dedicated to achieving your goals. You could do this by selling your car, and if you live close to work, you can bike to work, walk around, get your groceries delivered. So you don't have to have a car, but if you must have a car, let's have a look at some ways to still reduce this bill. There are actually many car rental sites where peer-to-peer people rent their car to each other, so one can make a bit of passive income and the other, say for example, if you don't need a car every week but there is some occasion, rare occasion where you do need a car, it's much cheaper just to rent it for the day than to actually have a car yourself where it's parked and you're not really using it much, but you're still paying, the monthly insurance, the rego and maintenance. And on the flip side, if you own your car and you don't use it much, you can also rent it out to other people to reduce your transportation costs or cover most of the rego, insurance and maintenance costs. And some people have even bought additional cars and rent them out and earn passive income. Now, if you can't rent a car, if you don't want to rent out your car, you still want a car, well then the next best thing to do is buy a second-hand car, maybe about 5 years old, because that's when most of the depreciation happens in the first 5 years, and you want a fuel-efficient car. This way you can still own a car, but cut your transportation costs probably by 60%. Alright, now the third biggest expense for most Australians is food. And I know all about food. Now this is something that can get really expensive if you don't keep your eye on it. And this is something that I'm always trying to work on. So what you can do to reduce your monthly food or grocery bill is shop at places like Aldi instead of Coles or Woolworths, meal prep all your meals, and that will greatly reduce your expenses. Not only this, but those $5 to $10 impulse buys that you buy at the checkout or buy for lunch every day can add up to thousands of dollars over the year. Okay, now let's get down to business. The thing that Australia's richest do best, and what you need to do, is what they do with their money is they make their money work hard for them. They don't work hard for money. How do they do that, Michael? They do this by investing. And I know you may be thinking, oh, investing's risky. I can't invest, I can't do it. The stock market's risky, property's risky, Bitcoin's risky, gold's risky, everything's too risky. Well, guess what? It is a risk. But where there's no risk, there's no reward. But the biggest risk right now is your money in the bank being devalued by central banks printing huge amounts of currency because they're in a race to devalue the currency so they can import inflation. Another thing, like I said, is inflation. That is devaluing your currency every year by 2 to 3%, and also the cost of living is rising higher than inflation. So if you do not invest, this is not financial advice, you are going to be left behind by the government and central banks devaluing the currency because they want to devalue the debt because that's the only way they can pay it back. So what do the Australia's richest invest in and how do they do it? They invest for the long term, 10 to 20 years, not 1 to 5 years like most people do. They also don't get emotional and they have an investment plan and stick to it. They don't try to time the market. They don't try to beat the market because even most professional hedge fund managers over 20 to 30 years cannot beat the market. Also, they diversify their investments in things like shares, bonds, cash, precious metals, even a small position in cryptocurrencies, and yes, even they invest in real estate. I'm going to let you in on a little secret that most people aren't aware of, but once you study the lives of the super rich and study this financial economic system, you come to the conclusion that this whole monetary and financial system is rigged to increase asset prices for the rich and to force people to invest and spend their money rather than save their money, and it's also rigged to increase inflation so governments can pay back their debts because there's no way they can pay back the debt with their current income and tax levels. For example, your parents may have a mortgage of $100,000 and you may think, oh, $100,000, that's a tiny mortgage. I wish my mortgage was only $100,000. But guess what? I bet when they got their mortgage 20 to 30 years ago, $100,000 was a lot of money. But due to the central banks and the government printing money and devaluing the currency and devaluing the debt, $100,000 isn't a lot of money anymore. And you may think that the government's being in billions of dollars of debt or hundreds of billions is a lot now, but in 30 years they'll be in trillions of debt and hundreds of billions won't be worth as much in the future. This is why we are in the worst recession in 90 years, but asset prices like stocks, precious metals have skyrocketed because central banks are printing currency. And you may think, how do they do this? Because before they printed paper, but now that's not even fast enough to print money. They need to get quicker. So they've come on the record, and this is not a theory anymore. This is a fact that they can just use a few keystrokes on the computer and print currency, and they do this by buying government bonds and mortgage-backed securities and setting up loan lending facilities to the banks. Even in the US, the Federal Reserve has started to do something that is not part of the Federal Reserve Act that was created in 1913. They've actually started buying corporate bonds. That means these big, huge companies that could be going under and their bonds, or aka their debt, their credit rating has dropped. The Federal Reserve's come in and boom, they're buying up these corporate bonds, and that way these companies can keep going, and that's why their share prices have risen and bond prices have risen, because investors think if things get really bad, the central banks will come in and save the day. Now let me prove to you that time in the market, not trying to time the market, is the most powerful tool. As you can see in this graph, if you miss just the top 40 trading days on the ASX over a 16-year time frame, you would have actually lost 25% of your investment instead of making a huge 370% gain from your $10,000 investment. Now, this is just an example, and past performance is no guarantee of future performance, but Albert Einstein said that compound interest is the eighth wonder of the world, and this is really true, and I'm going to show you how powerful compound interest is. So you've increased your income and you've increased your savings. Now you have, say for example, $1,000 left over to invest in index funds, and that's what Warren Buffett said he's going to do when he passes away. He's going to put most of his estate in index funds, because most people don't have the time or the profession to pick individual stocks. So what most people do these days is invest in index funds, where it diversifies your money across hundreds of companies, and that way you don't have to use leverage like real estate to get decent gains. Now looking at the historical returns of the ASX All Ords, it has actually returned 13% with dividends reinvested over the past 118 years. Now I'm going to be conservative in this scenario. Also the S&P 500 has returned around 9.5% over the past 90 years. But like I said, I'm going to be conservative in this scenario, and we're just going to say you're going to get a 7% return with $1,000 invested every month for the next 10 years. And let's look how our portfolio is after that time frame. So after 10 years of investing that $1,000 per month, your portfolio is now worth a huge $176,000. Now that's pretty cool, but the power of compound interest only gets better from here. So let's look at a 20-year time frame. After 20 years, your portfolio is now really starting to make some momentum, and it's more than tripled, with your portfolio now worth $495,000, but the power of compound interest just gets better and better. So let's look after 30 years. Congratulations, you're now a millionaire. Your portfolio after 30 years of compound interest is now worth 1.1 million, and you're definitely in a pretty good financial position now. But it's not super life-changing, because in some areas you can't even buy a house with 1.1 million. So let's look after a lifetime of earning from a young age, 20 to 25, 30, till retirement of 65 to 70, and see how our portfolio is looking. So now, after 40 years, your portfolio is worth $2.4 million. That's right, you've retired a multi-millionaire with a $2.4 million portfolio. And I know you may say, 40 years, that's too long. I'm not even going to bother. Well, guess what? That's what most Australians have thought, and that's why we're starting to see so many Australians that are coming into retirement age and they're broke and they have nothing, because they just didn't take the simple step of starting their investing journey, investing for the long term. and now they're really in trouble. And if you just start this, yes, you may not get rich quick, but you will thank yourself in your retirement, and you'll be able to live a much better retirement than most and spoil your grandkids. But I'm sure most of you don't want to wait 40 years, and that's why I keep telling you, you must create a disruptive business that can create huge amounts of value to people's lives and solve problems. That way you can achieve this number in, if you're lucky, 5 to 10 years, much faster than most. And that is how the top 250 richest Australians have created their wealth in a short amount of time. Yes, some have inherited it, but the majority, most of them, have actually been self-made, and through creating businesses, they've created a huge amount of wealth in a much shorter time than most. Now, you may be thinking starting a business is too risky or is too hard, but luckily we're in an age where starting a business has actually never been easier. With the power of the internet and social media, you can start a business with little to no upfront costs, just using your smartphone. That's what I'm doing. I'm just recording with my $495 smartphone and a $25 lav mic. I've spent thousands of dollars on equipment, but it's not necessary, and I know you can do it too. I know it may sound overwhelming and stressful, and yes, you may create your first, second, third, fourth, fifth, hey, maybe they may all fail. But with the power of internet and with social media and with technology, you can create businesses with little to no upfront costs. So if they fail, it's not a big deal. Not like spending $100,000 on a franchise or opening a retail store. Those are very risky right now, and we've seen that retail stores are dropping like flies. Now, I'm not trying to tell you what to do with your own life or trying to be tough. I'm saying this from love. I'm saying this because I see so many Australians doing things terrible with their personal finances. We're one of the most indebted nations in the world, and I can see that if you do not follow these steps that I said, you're going to be left behind to inflation, automation of the workforce, and globalization of the workforce. People think this working from home movement is great, but guess what? If your boss can have you working from home and remotely, he can also have people doing your job from overseas. So you need to take matters into your own hands and not have a victim mentality, and take your personal finances into your own hands. If this video brought you value and you haven't already, smash the like button for the whole YouTube algorithm. It really helps out the channel. And if you're still watching, you're awesome. It really does help out the channel by watching to the end. And if you haven't already, subscribe for more awesome content on personal finance investing, property market updates, and economy updates. And of course, I'll see you in the next video.